Time for Rapid Fire. Here with their take are Leslie Picker, Robert Frank, and Seema Modi. A very good afternoon to you all. Great to see you. I think this is my first ever Rapid Fire. First topic, a dilemma for Disney. The company announcing it will close its Hong Kong theme park on Wednesday, July 15, amid a spike in new coronavirus cases. This comes as Disney World in Orlando, Florida, just reopened over the weekend. Our own Julia Boston joins us now with the latest details on this particular Disney part of the story. Julia, what can you tell us?
Well, Disney announced that it's being required by the Hong Kong government and health authorities to temporarily close Hong Kong Disneyland on July 15th. The resort's hotels will remain open with adjusted levels of services. No word on when they'll be able to reopen that park again. Now, this comes after Disney World started its phased reopening this past weekend, welcoming thousands of guests. Now, they gave us no word on whether they'll reclose that park if Florida cases continue to spike, but Disney tells me they can adjust capacity numbers in order to continue to operate in this new world. And Goldman Sachs initiated coverage of Disney with a buy rating and $137 price target on the stock, saying it expects the media giant's parks and studios to fully recover after COVID, and that synergies with Disney's direct-to-consumer streaming business are underappreciated. Well,
Julia, thank you very much. I mean, Robert, it's such an interesting snapshot, the fact that this is all taking place in Florida, which is a state that's continuing to see cases rise and spike, and yet we're kind of reopening regardless. In one sense, it's quite encouraging, and it's perhaps what the stock market is reacting to in general, that we can just plow on.
It is encouraging, and I think if anyone can do it right, it is Disney. I mean, they just have incredible protocols there, and they are a model in a way for the rest of Florida to perhaps follow some of those protocols and get those numbers down. But it reminds us how important theme parks are to Disney. You know, we think of it as a content company, but 37% of its revenues come from theme parks, and that is why there is such this imperative at Disney to open, perhaps regardless of what's going on in the context of cases in Florida compared to Hong Kong.
Yeah, the Hong Kong one shutting down, a reminder of how carefully they have to play it. Seema, I guess a lot of companies that you follow so closely will be watching whether Disney can do this well with very, very close attention.
Yeah, absolutely. It kind of speaks to this balancing act that entertainment and hospitality firms are really trying to conquer, which is reopening their hotels, their properties, but at the same time prioritizing safety. There was one analyst that called the Disney reopening, Will, the ultimate economic bellwether, because it tells you a lot about a consumer's willingness to not only spend money on a vacation wherever they are around the world, but also their willingness to be in close proximity with other people.
Leslie, I guess many of these most effective hospitality-type stocks, and Disney has a lot of other parts of the business too, of course, have been hit much, much harder than Disney's stock has. Of course, it's off its highs of 150, but well off its lows of 80 as well. And I guess the hedge funds out there aren't sort of aggressively trying to short this one or play it as a bust or bounce-back type stock.
Maybe not Disney per se, but there's definitely a basket of companies that the hedge funds are looking at that they are correlated with reopening trends and pulling back on those trends. Cruise ships, for one, is definitely in that bucket. And so I think you're right. Disney is a little bit more diversified. So it's something that if they were shorting it, they'd be shorting it probably more based on valuation than anything. And the Goldman Sachs note highlighting those synergies is something I think that hedge funds are looking at with this one, too. But you're right. We're seeing a very high beta on especially entertainment and hospitality stocks that are so directly tied to whether or not these economies can reopen.
I mean, Julia, Disney's up again today, 0.5% or so, so behind the rest of the market, but shrugging off that headline on the Hong Kong park.
Yeah, look, I think that the stock started moving higher on that Goldman Sachs note, and the idea, that confidence that Disney's studio and its theme parks do have the potential to fully recover. I mean, there are so many questions still about the theatrical movie-going business, and we're waiting for theaters to open, waiting to see if Disney will have to delay its release of Mulan yet again. But that Goldman note had a lot of optimism, sort of looking at the long-term potential of this company.
Julia Boston, thanks so much for joining us on that story. By the way, Netflix, Disney's rival in a different subsector, reports on Thursday and is up 75% year-to-date. One to watch this week for sure. Next topic, PepsiCo shares higher after topping estimates. The company saw a big bump in sales for its Frito-Lay business. The snack sales surge helped offset a decline in its core beverages business. PepsiCo CFO Hugh Johnston was on Squawk Box earlier today, talked about how the reopening of the economy will impact the company.
The snacks and foods business very much benefiting from people staying and eating at home. Beverage business doing less well. As mobility increased toward the end of the quarter, you saw the beverage business start to come on more strongly, and snacks sustaining well. So we kind of feel like we're about a perfect hedge in terms of we benefit from lockdown, we benefit from people becoming more mobile again.
A really interesting point there, I thought, in terms of their parts of the business being diametrically opposed. By the way, while PepsiCo also reported a $400 million hit from virus-related costs, Johnson noted the financial impact should diminish moving forward. Seema, the other kind of standout from that interview, I thought, this morning in the numbers was China sales up 30%, Germany sales up 18%, and clearly there a correlation. Handle the virus well, and you'll see consumers come back more meaningfully. Yeah, another gauge of consumers willing to spend more money, whether it be on snacks or cruises, or whether it be a ticket to a Disney park. But I think the interesting part about snacks, we've been sort of debating some of the lasting impacts of COVID and whether, snacks will be sort of here to stay. I can certainly attest to that. On days when I'm working from home, snacking is certainly a big part of my work and life balance. But perhaps this is, in fact, a bullish call on Peloton. If that's the case, more of us will be working out. Yeah, well, that's true. Particularly the salty snacks, I think they were saying, were highest up on the list. Leslie, still no guidance, which speaks to a difficult theme as we enter all of earnings season of how people are meant to really value these stocks.
Exactly. And they talk about, the unpredictability and the volatility in their sales, especially as you see different pockets of the economies opening up, different parts closing down, and how that impacts their business. It's impossible for them to really predict the future for their business. And what I think, to Seema's point, is interesting is just the stickiness of this snacks the snacks division, and whether, once these economies do start opening back up again, do people continue to eat Fritos? If you're stressed drinking during a pandemic, you're probably not opting for Pepsi. You're probably opting for the wine instead in your fridge.
Yeah, but then you need a Pepsi.
At least that's been my case.
A Pepsi in the morning to get you going again. The caffeine plus sugar, I always think
Exactly, the caffeine.
Better even still than
That's
coffee
the perfect
does.
hedge he referred to.
Exactly.
Yeah.
Robert, where do you stand on this one? Interesting, in terms of snacks, we're all saying it's because we're being greedy, but Quaker was very strong for them. I guess Quaker's healthy stuff. I'm not actually sure, but up 23%.
Yeah, Quaker up 23%, and that's what was interesting. Hugh Johnson's conversation with Sarah this morning, where he was saying, yes, we're indulging, we're eating all the Lays and the chips and all the unhealthy carbs, but we're also eating healthy. And I think you could say that Quaker Oats is on the healthy side. And it's interesting when you compare Coke and Pepsi, and my first job at the Wall Street Journal more than 25 years ago was covering these two companies, and this argument, the eternal existential argument about whether it's better to have a basket of food and beverage or just pure play beverage. And this pandemic has been better for Pepsi because it has the food side, and there is this snacking stay-at-home element.
Next story on the list, embattled office-based provider WeWork says it's on track to reach profitability and positive cash flow sometime next year. That's a year ahead of schedule. Executive Chairman Marcelo Claure told the Financial Times it's seeing strong demand for its flexible workspaces amid the pandemic, including new lease agreements with giants like MasterCard, Microsoft and Citigroup. Its valuation has fallen from nearly $50 billion in early 2019 to less than $3 billion in March. Robert, I'll come to you first on this one. I mean, it's not a full release from them, but certainly the tone of it was positive, what we learned from the interview in the Financial Times. But you could see how, in general, office space is going to be under pressure with the work from home trend, but that within office as a business, if people are downsizing and getting rid of their full building, that the subsector of shared spaces could benefit.
Yeah, look, on the one hand, I was surprised they're saying cash flow positive by 2021, because this is a company that had very long-term leases that they had taken at the peak of the market at very expensive rates. And they had a lot of customers, their own clients, that presumably weren't paying because they weren't coming to work. In fact, the fact that they're going to be cash flow positive is surprising and strong, and a sign of just how small they went, from 14,000 workers to about 5,600. So this is a much smaller company. But there will be the question of, can you grow? It's not just can you shrink to profitability in 2021, but what is the growth plan? And that, beyond the occasional office that may be sort of expanding because they need more space, I just don't know what that proposition is right now.
Well, they've certainly cut costs in the meantime, workforce from 14,000 down to 5,600. I think that was the first time we got specific numbers on that. Leslie, the other really crazy situation we have here, Clore, COO at SoftBank and chairman of WeWork, and the two are in litigation against each other in terms of SoftBank trying to back out some of the terms of its rescue package. Kind of reminded me that there was that level of overlap in terms of the management. Still unclear how that gets settled. And, of course, Adam Newman is the person that will be watching that most interested.
Absolutely, because that's what determines, helps determine his pay package. And I think what's interesting with regard to WeWork and its plight and its ability to become cash flow positive, to Robert's point, is this idea of how it is actually trying to capitalize in this era of COVID. That companies have decided that they're not opening their doors, but they're letting their employees go into WeWork and, if they need to, and having, in-person, face-to-face meetings there. My question, and one thing I was trying to look into before we had this chat, is whether or not companies are still liable if their employees get sick at a WeWork. Whose liability is it if there is some sort of contagion that takes place at a WeWork versus if you're, and they mentioned, Citigroup is one of the companies that's been doing this. If you're Citigroup, does that kind of pass on the liability for your employees getting sick? I'm not sure, actually.
Yeah, it'll be an interesting deciding factor, I'm sure, long term for them if they have later costs. But a rare positive update on WeWork. Finally, shares of Carnival lower after announcing plans to cut its fleet by 13 ships, about 9% of its total capacity. The cruise line said it's part of a reorganization effort as it continues to burn cash with U.S. sailings suspended amid the coronavirus pandemic. However, the company says it does expect a bounce back in consumer demand for next year. The CDC's no-sail order expires later this month, though most cruise lines have paused sailings through until about September here in the U.S. I mean, Seema, it's down a bit today. It was up sharply on Friday. The note arguing that they're a long-term winner. It's hard for us to look at that yet, but you can read the note and see it's all about cost-cutting, shrinking their fleet, and they'll have in a more profitable position the other side.
Yeah, and with Carnival being the largest of the three publicly traded cruise lines, it's burning around $650 million of cash every month. So the pressure is really building on Carnival to find different ways to cut costs and also raise some capital. One way to do that is to evaluate all the assets it owns, which includes over 100 ships. It has ports, it has private islands. They'll probably hold on to those private islands. That's one way they can sort of control the experience when they do resume sailings back in the fall in the Caribbean. But in terms of ships, I think the big question is who's going to buy a big cruise ship? I mean, these are large vessels that many of them have a lot of debt associated with each vessel. So that's something to keep in mind. It would likely be a larger bank, a brokerage, perhaps a European cruise line that would resume sailings before U.S. sailings, so that's something to watch as well. But this will definitely be something to watch going forward.
Or perhaps, Robert, one of your billionaires who's gained significantly in wealth this year, who wants a seriously big private yacht.
I was just thinking that wealth. Elon Musk at 70 billion, he could buy a Carnival cruise ship and ski behind it. I mean, how cool a picture would that be?
He could buy one with just today's share price gains. Leslie, final word.
Yeah, he'd need to make it electric, though.
Well,
those cruise ships, they burn off a lot of fuel.
You need a big battery for one of them. Guys, thanks so much. Leslie, Robert, and Seema, pleasure.